Well, let's cut across to Latha, who's now in conversation with the JPMorgan Brain Trust ahead of the all-important investor conference on a day where the markets are at a record high. Over to you, Latha.
The Fed has delivered a supersized cut, and EM central bankers, like the Reserve Bank, will now have to face up to a 4.4% Fed funds rate by year-end and as low as 3.4% by end of 2025. So will dollars rush to emerging markets because you earn less on US bonds? Will the Reserve Bank have to cut rates to avert a rupee depreciation? The FOMC has also, remember, lowered the US growth forecast just marginally from 2.1 to 2% for the current year. It has upped the unemployment forecast to 4.4% from 4%. This will mean a slowdown in global growth, or will it? Then which stocks would be best bets for an Indian investor? For a 360-degree perspective on the Indian and global markets and macros, I have with me the JPMorgan Brain Trust. Sajjid Chinoy, the economist, Sanjay Mookim, the head of equities and research, and Kaustubh Kulkarni, the head of country head in India. They've all been kind enough to come over ahead of their all-important investor conference on Monday. And so here's trying to get everything that foreign investors think about us. But first, Sajjid, first things first, the Fed cut. What does this mean? Yeah. Now is a Reserve Bank rate cut imminent in 2024?
So first, let's talk about the Fed cut. And, our US team had called for a 50 basis point cut, so this is not a surprise. I think what matters more than the quantum of whether this was 25 or 50 is why is the Fed cutting? Is the Fed cutting because the US is on the cusp of a recession? And our answer is no. In fact, if you look at the Fed Atlanta's nowcast, growth in the third quarter in the US is tracking 3%. The consumer is extremely solid. So the Fed moved because the balance of risk has now changed. They're much more comfortable that inflation is heading towards 2%, and they're a little bit concerned that the labor market has begun to soften. If you look at their own Taylor rule, right, about where rates should be, given this mix of unemployment and inflation, it should be at 3%, 3.5%. So there was this 250 basis point level shift that they had to undertake, and that's the way to understand this 50 basis point cut, that we may see more of it if the labor market slows in the coming months. Don't rule out another 50 in November if the labor market slows. But the point is that rates are now much above where conditions on the ground in terms of growth, inflation, the labor market are. The important part is the US is not slipping into recession just as yet. So they're cutting, in a sense, from a position of strength. This was a happy cut because inflation is coming off faster than they actually thought. What does this mean for emerging market central banks, Latha? There are going to be a lot of idiosyncratic factors. We should not rush to
India.
First, India. Well, let me just lay the backdrop by saying Brazil hiked yesterday by 25. Bank Indonesia cut by 25 even before the Fed. So a lot of idiosyncratic factors will matter for emerging markets. I think for the RBI, again, the news is incrementally positive, that despite a slight upside surprise to CPI last month, despite the fact that September CPI could bounce back to 4.8 or 4.9, there's more conviction now with every passing week and every passing month that food inflation is going to gap down. We've had a strong monsoon. It looks like a good sowing season. Global
so
food
for domestic reasons, you're saying?
So, but I do think the RBI will want to see a little bit more data. So we actually think in October they'll still hold their gunpowder. They'll want a little bit more conviction that, yes, food inflation after 3 years of being sticky is finally going down. And as the governor keeps saying, it's not about being at 4% for a month. It's about durably seeing 4% for the next few quarters. But this does, I'll end by saying, if the Fed cutting this year increases the odds of a soft landing in the US, that's a very good global environment for risk assets in emerging markets in 2025.
Our viewers are dying to hear what it does to Indian stocks. But very quickly, would you believe that there is still a global cloud on Indian growth? The domestic factors are pro-growth, yes, but there is a global slowdown?
No question that, yes, the US is holding up, but look at the other parts of the world. There's been a lot of US exceptionalism. Europe has been soft. China continues to soften. So global growth is going to soften. And as we saw in the latest trade report, we won't get the same tailwind from exports that we have been getting over much of the last 2 years.
Okay. Well, with that, let's come to the area where we are, immediately interested in stocks. Sanjay, I read your report on how India is in a late cycle of the business cycle. First, just explain to us before I bring the Fed in.
Well, look, we've seen for the last few years in India very strong stimulus support, very strong economic growth, upgrades which are rare in India to earnings estimates and companies beating forecasts. That seems to have faded away, Latha. Right? And in
the first quarter saw downgrades.
That's right. And a significant number of downgrades, which actually is very rare for 1Q. We normally see downgrades in 3Q and 4Q towards the end of the year, but we've actually seen misses and downgrades in 1Q. We've also seen the downgrades to the GDP number, for example, as well. And that's one of the reasons we are talking about slightly late cycle dynamics in equity markets. Of course, we've stopped talking about valuations because, that signal has been flashing red for 2 years now. But in terms of growth, in terms of outcomes of companies, earnings momentum also, it does appear that we are more than through a significant upcycle in the equities market at least.
Okay, so therefore is it avoid equities or is it some kind of equities?
Well, that's a bit hard.
What would your preferences?
Right, so it's difficult to say avoid equities entirely because, of course, let's say if you're a local investor, Latha, and this is one of the challenges.
Yeah, else will I put my money?
Exactly, right. With the tax incentives that we have in the economy, equities still appear relatively decent on an expected return basis, right? And it's difficult, therefore, to say you sell everything and leave the market. It's the only thing that we argue is that a lot of corners of the market are propped up principally on liquidity. And when things turn, it is that liquidity that presents a risk. See, the one thing that people forget at the top of every bubble, we don't know when it will be, is liquidity. Right? Bubbles burst because of liquidity issues. And therefore, our advice to investors is that in all of your participation, be cognizant of quality risks, right? Do not compromise on having...
Quality.
Exactly, right. We can't
you're never left holding a lemon.
Exactly, because when the tide turns and you should not be unable to get out of your stock.
No, but what is a typical late cycle stock that does well? If you're in the late cycle, obviously the big growth areas, consumption should not do well. What should do well?
Well, as of now, we are overweight consumption, Latha. Okay. And this is because we've...
Both durables and FMCG?
More durables, more FMCG, I beg your pardon, for now. And this is because we expect, the K-shaped recovery that, we've had post-COVID to converge a little bit. Okay. We're starting to see a little bit of signs of it. It's still very early to kind of convincingly argue it, but there is hope that this might happen. So we are actually overweight the staple stocks.
And what else?
We like real estate, for example. We think the momentum, again, going back to the argument, where else will you put your money? The equity market benefits from it. The real estate market should also benefit from it. We are overweight healthcare. We also like, so we are not very keen, let's say, on the IT and material space as of now.
No, I would assume healthcare is a late cycle preference. It's a defensive.
It is.
I want to come back on whether the K is converging, even slightly. But before that, Kaustubh, the big point is that FIIs are not flowing into Indian equities as much as they're even flowing into Indian debt. When you look at the data around, quite a few GEM funds are, not up to the weight they should be, rather underweight India's, weightage in, for instance, MSCI. What's your sense about how they will behave now? Do you expect that now, with the dollar also weakening, will there be a FOMO and they rush in?
I think it's true that relative to the MSCI weightage that India has, FII ownership is still, at least depending on the day, 2 to 3% lower than what it should be. But a big reason for that is the weights for India have increased meaningfully compared to where they were 3 years ago. Two, Indian market and FII, a number of the largest FIIs understanding in the Indian market was reasonably limited to around 75 to 100 of the larger liquid stocks, as Sanjay mentioned. Whereas, as we know in India in the last 3 to 4 years in particular, the breadth of the market and number of companies which have created excess returns is way, way larger than just the 75 or 100 companies. FIIs, therefore, have to go through their own recalibration and understanding of the market in India. Once they're able to do that, and that's where we are seeing so much more interest from FIIs to understand exactly what's happening. Because of the change in weightage, they have to do more work. But equally, they have to do a lot more work in terms of the complexity and the breadth of the stocks that they have to start covering. We think they are doing active work, and hopefully, I think, therefore, the money will follow once they finish the work.
Okay. I want to come to Sanjay on, the stock preferences. Aren't FIs put off by the valuations? I mean, at least in the mid-cap, do you ever see them broadening beyond the large caps?
Well, to a large extent, they have. If you look at data across Asia, Latha, the largest off-benchmark exposure for foreign investors is in India, right? Whereas in other countries, foreign investors may not even own the entire index constituents. In India, they own a far broader. It's still not a very big divergence, but at least within India, the foreign exposure off-benchmark is reasonably high. Are we starting to see interest? We do get questions from people about, hey, what's going on in this part of the market, etc. But the one sort of feedback, if I may, people are generally cognizant about valuation issues, right? And they don't want to be, like I said, be caught buying the top. And especially
so
when
that is a deterrent.
There is a deterrent. Okay. Especially when you contrast Indian valuations to similar sectors, similar countries elsewhere, the divergence looks very stark at the moment. So I do get this resistance saying, hey, look, I'm okay with the set of stocks I have in India for now. I really can't make up my mind and convince myself to buy anything.
I want to put the incremental money. But what about large banks? I mean, Sajjid is saying that if not a rate cut in October, it's somewhere there in the horizon. What does that do to your view of financials?
Well, I think most foreign investors, of course, have a decent exposure to financials already, right? And this is a legacy exposure. It's a macro view, take an economy to just go buy a set of banks in the country. That's how it's played out for many years now. And what we're seeing, of course, is banks are best placed on the valuation filter, Latha, but on the growth momentum, naturally, there has been a significant slowdown, right? In the terms of the YOY growth that you got in 22 and 23, the growth we are now getting out of banks is much more meager. So the debate you have in the investment sort of ranking, this looks great on valuation, but the growth number is perhaps no longer as exciting as it used to be. Now, our pushback is, look, relative to growth valuation or a PEG ratio.
So, may prefer NBFC in that case, no?
Yes, but NBFCs can be far more cyclical.
Okay.
Right. You have to take a cycle view, sector view, rate view, for example.
Fair enough. I have more questions on the rate view as well and what it does to bank margins. As well, there's very interesting point to make about whether the K is not widening, but probably lessening, and more important, dollar. Dollar and dollar rupee. Where is it headed? All those questions to the JPM Brain Trust after the break.